Good morning, everyone, and welcome back to Morning Markets on Monday, the 27th of April. I hope you've had a good weekend, and here's a few things that I'd like to share with you today. And the first of which is just sort of reflecting on what happened last week in markets. And I think one of the noticeable things when I look back over the data from last week is just the effect of sort of the normalcy in markets, for want of a better word. And in particular, that was very evident in the bond markets, particularly the sovereign bond markets over the course of last week, where we saw little movement in key Treasury yield levels in the US and also in the UK, with both 10-year Treasuries remaining around 60 basis points and UK yields around 30 basis points. So no real change or volatility over the course of the week. I think where did we observe volatility last week? Primarily in the oil market, particularly at the start of the work, where we saw the very significant movements in WTI. Obviously, as the week wore on, those markets started to normalise, and we saw a rebound in the oil prices as the transactions in the futures market moved to the June contract from the May contract. The other area of volatility as well that has been observed declining over the course of last week was the VIX index, with the VIX now at approximately 35. And that just gives you an indication as to where volatility has got to. If we cast our minds back about 4 or 5 weeks ago, we would have been talking about levels of volatility over 80. So a significant reduction in implied equity market volatility going forward. Turning now to the week ahead, one of the things that we were touching on last week was the EU and the package that had been put in place, and whether Italian debt would see a downgrade from S&P from the BBB status that it currently has. S&P came out over the weekend, I think on Friday night, with their report, and there's no change to Italian debt rating. So it's BBB that remains two grades, I should say, above junk status. They did mention the debt to GDP levels of Italy at being over 150%, and also, but more importantly, I suppose from the market's perspective, that they felt that the government bond purchase programmes for the ECB would be sufficient to offset some of the concerns that maybe they did have. So that continues to play out. Italian bond spreads still remain elevated relative to the Northern Europeans, and particularly to Germany. Focusing now on the week ahead, well, we've got an interesting week of company reporting coming up, with a number of the large US tech businesses reporting, and this will be important for the market. They have been the stocks that have led the market over the past number of months, and more importantly, they've led in this rebound that we've seen in the US. That has caused the US market to become narrow. What do I mean by that? Just the number of stocks that are driving the advance that we're seeing. And indeed, some of these large tech companies taken together account for about 20% of the S&P. So it'll be important to see that they can continue to deliver on the growth trends that they have in the past number of reporting seasons. So that's something to watch over the coming days. We also have a number of the major central banks meeting, and with the Fed, the Bank of Japan and the ECB. I think in all cases we're not expecting any change in interest rates. What will be the more interesting and observed factors will be around the press conferences, how they discuss the current situation and any planned further moves that they are making. And then indeed on that vein, we've had the Bank of Japan this morning come out with the various sets of initiatives focused around the government bond market, so moving to unlimited purchases, and also increasing the purchases that they will be making in the corporate bond market and commercial paper market. That follows a similar direction to what we've seen from both the Federal Reserve and the Bank of England. And in addition to that, they will continue with their purchase programs of ETFs in the Japanese market and J-REITs, which are real estate investment trusts in Japan. And then just thinking about the data that we'll get over the coming days, we'll get a first quarter GDP report for the US. Obviously backward looking, but may give us an initial indication of the damage to the economy that occurred in March. And then with a lot of survey evidence over the coming days. I think for me, the survey evidence from those countries that are still in lockdown probably is not going to tell us very much. More important will be the PMI numbers for China towards the end of the week, which will allow us to assess whether the rebound that we saw in March has continued into April. I'd also just like to encourage you to pick up on the charts that my colleague Chris Leyland will be discussing a couple of times during the week, and also just the blog post that we made on the oil market on Friday. I'll join you again tomorrow. Thanks very much for watching today.